the structure. We have 80,000 square feet here in Austin. We've got 26,000 square feet in Dallas. That's actually going to expand this year. We do bus trips, like I said, on the third Tuesday of every month. We actually need to update this because we are now operating out of the Cannon in Houston, which is an awesome 100,000 square foot facility in Houston that we have full access to in our reciprocal memberships. We don't operate the space. It's not our facility. We don't pay rent, but as a member here, you can go over there and use it just as much. And so it's effectually part of our ecosystem.
Where's that located in Houston?
They actually have a couple locations now. The first one, does anyone know the big one where it's?
I know Houston.
You know Houston? It's it's west of downtown, the second loop. It's pretty far west. There's like the medical city there? Or?
Well, there's the energy corridor right out there.
Yeah, I think it's near the energy corridor. I need to get better at describing where it's at. And then they've got a location downtown as well.
No, I like the west side better. It's
closer for us, for sure.
I used to live out there too.
Northwest Houston, below Jersey Village.
Yeah.
You know, wherever that Jersey Village is.
Yeah. This is our team. This is actually way smaller than it is now. This was probably 2 or 3 years ago when we were about 50 people, and we're now going to cross 100 in the next week or two. So we got 100 full-time people making this thing go. It's no small business. Okay, so talking about fundraising. Sweet. So this is a graph. It's always this decision. It's like, do you raise money? Do you not raise money? This is kind of one way to look at it, and it really, what everyone says, it depends, right? It depends on your business, depends on your personal situation, what you're looking to get out of the business. But we think kind of the two big functions are scalability and capital intensive. So things that are not super scalable, not super capital intensive, definitely probably just want to bootstrap that one. But things that are capital intensive and super scalable, it's probably more you need to raise money for that, raise VC. And then you can kind of, capital intensive, not scalable, not really something you want to work on. And then you can see the top left corner is kind of a mixture between them both.
Evaluating those barriers is the hardest thing you have to do.
Right. Yeah, I think for me, I always really ask the founders to think hard about what they want out of the company. And I think if you do want a very highly scalable company that changes the world, it's the next Facebook, probably gonna need to raise money for that. But there's a lot of things you give up. There's a price to pay for raising money, right? And we can get into this, but ultimately, once you raise money, it's no longer you're no longer in control. You might have control of the board, you might be able to pass things, but you're signing up for a plan, right? And you raise money saying, I'm going to do this, and if you don't do that, you're in trouble. And so it's like once you know, like, okay, I'm ready to take that risk, like I'm ready to raise money, take to the moon, and I'm ready to go to zero if it doesn't work out. Or if not, it's like, hey, let's just nurture this thing, bootstrap it until we decide that.
Take a long time.
It's a great point. When very tactical with some individual investors, you're thinking like, how do you build a relationship? How do I get this person to invest in my company? They're not going to do it on the first time, right? Maybe it happens occasionally, but in general, it takes a long time to build trust with the investor so that they will partner with you. And so they invest in lines, not dots. When you create a relationship, every interaction with them starts to put together this pattern and this profile of you as an entrepreneur and you as a company. And so the idea is every interaction you want to be able to communicate how you've built value in the company since the last interaction, right? And you want to build that line so that it looks like you're growing and that you're making progress, and manage those expectations versus, hey, I'm going to show up when I'm ready to raise money and you're going to give me funds. That's not really how it happens. Usually investors will know an entrepreneur for at least a year, if not 2 or 3 or way longer before they invest. Okay, raising a seed fund. These are the 5 kind of big buckets we like to recommend founders try to check. This is always a moving target, and it's an art and a science, so this is obviously not 100% foolproof, but number one thing is a team to believe in. One that believes like, yeah, they're super talented and they're going to build a product and they're going to sell it and all that, but also a team they believe in, meaning that they're trustworthy, right? And they're telling them the truth and they're being transparent and they're not going to run away with their money. And if shit goes sideways, they're not going to, they're going to handle it with integrity instead of that. I think that's such a huge thing for investors, is that trust piece with the individual. Big market, right? Investors are looking, how big can this thing get? What's the upper limit? And so being able to sell into a market and say, hey, my product, there's this many people out there that are going to buy it, that would buy it, and they're going to pay this much per year for it, and then that equals over $1 billion. Really great if that's like multiple billions. Meaningful customer traction. So this can mean a few different things depending on your company. How I like to describe it is you need evidence that your product creates value for your customers. And the best way is people just flat out buying it, right? And if people are buying it and they're buying it again and they're telling the marketing teams, telling the sales team to buy it, then that's like the best evidence you can show and really, really helps. But it's not always that easy, right? You need to raise money before you get revenue and other things. So other meaningful pieces of traction might be an LOI, might be a pilot program where they're maybe not paying you yet. It might be just like some interviews you conduct. But money changing hands is the big piece of evidence. Most investors follow other investors. 10% of the investors are kind of the lead investors that are going to, whether it's an angel or a VC, they're generally following each other, and so it's like, how do you find one influential investor that other investors will follow? And then you need to have a minimum viable product.
Yes, you talk about point 4 a bit.
Yeah, I mean it's the social proof. Investors, I think it's for better or worse, it's just as much about what are my peers investing in as is this company worth investing. And so it's kind of a flock mentality, and that's why you see most of the big funds. You look in Silicon Valley, which is a different ballgame than we're playing here. Bigger numbers, but they're all of the big funds are paying a premium to get in these top deals. So they all trying to get in the same deals. That creates this competition, which is really favorable for the entrepreneurs that are in the top deals. Because once you get that first investor, you're kind of on. And so I think, that's the idea is, if you get an investor that, if you're talking about an angel investor, it's someone local with a name, Josh Baer would be one, or, these other, Mark Cuban would be one. If you get one of those people that will let you share their name, then you get a lot of these other folks that, they don't know as much. We're like, hey, Cuban invested, like, Any questions on this piece?
With the MVP, are you also expected to show a vision of the growth after MVP?
Yeah, I think that's secondary or at one level deeper.
Mm-hmm.
Yeah, you certainly want to have the vision. I don't know if you have to have like it all figured out and like this calculated roadmap. Not that would be bad.
Sure.
But I think if you've got a vision where it's like, hey, this is what it's doing today. It's more like because that affects your market too, right? It's like, hey, here's my product today, with just these features. The market's this big, but hey, in the future we've got some additional features we think we can roll out, which doubles the amount of money we can charge our customers every year, which doubles the size of our market. So that stuff's really meaningful. But I think it'll resonate more with an investor if you're talking about increasing the market size than like building the product, right? So people, I think, entrepreneurs and people that are building this stuff, they love to tinker and create things and build things. Like investors don't really give a shit about that, right? Like they're caring about money and business. And so a big thing we always have to remind founders is like, hey, we want to invest in someone that's building a company, not a product, right? So.
Can you expand a little bit more on the billion-dollar growing market? Because being an entrepreneur, I could say it's going to be $10 billion. How do I prove it?
Yeah, Yeah, I think it's a simple calculation. It's how much do you charge a customer per year? So if they're paying $1 per month, it's $12 a year times the number of customers, and you need to use some kind of research that's out there. A lot of times it can just be a Google search and this stuff comes up and you got a credible source, and you just times that annual the amount you make per customer per year times the number of customers, and then that comes into the
Well,
market
yeah, but
size.
I mean, I know I get that, but like how many customers am I expecting to have? I'm just trying
Right.
to get into the
Right.
investor's head.
Yeah, again, it's gonna it depends, and ultimately the what you're trying to achieve is the conviction in the investor that this is going to be the best investment they can make right now, right? And you can build that conviction by driving all 5 of those levers. From a customer standpoint, I think that one, like, you get the most bang for your buck with an investor by adding customers, right? They care more about customers than, I don't know if they come out and say it, but they're paying attention to customers and revenue a lot. So I mean, I think it's for a seed round, we're talking about $500,000 to answer your question. It's like you just need a couple customers. It's that meaningful customer traction. It's not about how much, but it's about the quality of it. And if you just show me one customer, especially if you're a B2B company, you got one customer that's like, hey, this is freaking changing the game for our business, and we're not going to just roll it out to our whole marketing team, but we're going to roll it out to our sales and our development team. Like, that's like more exciting than, hey, I've got 5 companies using it. I don't really know if they like it or not, right?
So you gotta show some revenue.
Yeah, it's this evidence. It's how do you create evidence that is not just you saying it, even though it might be the same information. It's like, no, here's this document or this data that we collected, or here's this testimonial from one of our early customers that says, hey, this is what we need.
I have a question.
Yes, sir.
So like when you say like a minimal viable product, I feel like that becomes a little bit difficult to even show social proof for that if you have funding. So is it better to do it at a sample size? Because if you roll out a minimal viable product to the public and some other company sees it and this has some sort of traction, you could just get lost, because usually you kind of need a good marketing fund in order to like even roll out a minimal viable product. So you're going to be playing with the big boys, but you don't have big boy money.
That's called second mover advantage.
Right. It's hard. So what's the question? Can you?
So like, would you say like rolling out a minimal viable product to a certain sample of people, like just kind of like it's like exclusive sort of thing, be better than just rolling out to the public? Because when you roll it out to the public, you give other people the opportunity to actually.
Yeah, it depends a little bit on what you're rolling out, and if there's something that's super proprietary, maybe. I generally would, I try to ignore any part of me that wants to keep it a secret, and because I think that like there's trade-offs, right? And sure, you run a risk that there's some company that'll see it, but I think that risk is pretty low because they're not paying attention to you. They can't. Like, they don't have the time. They don't see you. They're not watching your face. But there is a risk that happens, but it's small. But the benefit that you'll get by putting it out there via the feedback is just so much higher. Because when you build things in isolation, you're just using your own perspective versus other people's data. And so I just always, and it's a kind of a balancing act, but I'm always err on the side of get it out to as much people as possible, get the feedback, and move as fast as I can. And then like my first objective, like with the company is like, how do I create a unique go-to-market channel that those people with big money like can't come into no matter how much money they have? And then once you've got that, you're kind of in business and you can start growing from there.
So that's what I was thinking too. Like when you like without having some like, I'm just had a similar situation before. It's just like if you don't have like with a minimal viable product, even to like roll it out the way you want to roll it out, it'd be much more difficult. Like without having that marketing fund.
Right.
That's why I was always thinking like it would be a good idea just to have like a select group to like you just roll out. You could hire.
I think it's smart just start. It depends on how many. I guess a big piece of it is how many users and customers you need to have a relevant sample size. Some products you only need 1 or 2 people to use it to figure out if it works or not. But some products you might need 100 people to use it, right? And then it comes down to this game of like, okay, how many people can I get on the closed beta versus the open beta? What I wouldn't recommend you do is go out and launch it publicly and go spend a bunch of money immediately for people to go see it. Like that, then that's probably inefficient spend. But you know, I would try to use grassroots free channels to get it as wide as possible. And you know, now we can chat later a little more about maybe your specific product, but it would be great. There was a day in Silicon Valley, you know, in the 90s where you would show up and you could get $1 million to go build that, and you didn't have to have experience or be a serial entrepreneur. But that's just not today. There's just there's so many fundable companies and a limited supply of capital for investors. That's actually what's holding more companies from getting funded back is not the number of companies that are worthy of funding. There's plenty of those. It's actually how many companies or how many LP investors are there out there that are going to give VCs money to go invest in companies. That's where the shortage is. All right, let me keep moving forward. But drive through the end of this, and then we'll just break into questions. I want to get Matt up here. I know he's got good perspectives on all this. Some accelerators, just some lists that you can reference. There's so many accelerators in Austin, for-profit, nonprofit, angel networks all over the state, seed funds popping up left and right. More Series A investors, corporate investors. This is not comprehensive either. Some new funds, VCs. This list is so much longer too. It's, you know, almost every major VC fund is traveling to Austin, to Texas to look at deals now. Some non-tech VCs. Some books to read. If anyone's like, I need to know all the language and like lexicon and legal side of it, venture deals, highly recommended. It's pretty much a must read. And that's going to make you sound a lot smarter going to talk to investors because you're going to know what liquidation preferences are and participating preferred rights and things like that. We always at our events like to take a moment to just kind of look around the room and notice who's not here. We're very committed to diversity in tech. We think this is one of the biggest changes and movements of our time. And so, one, if you know people of color, women, veterans, please invite them in. Two, and this is basic, don't do anything that keeps those people away. Sweet, let's welcome Matt and we'll get chatting. Sit here.
Sure.
So Matt, you want to just maybe give us a quick introduction and we'll dive into questions?
Sure. So I moved to Austin in 2013 in February. It's actually my son's birthday that we arrived here, and that was because I grew up in South Florida, was trying to start a tech company there, actually did start it, but when it came time to raise money, it was like, okay, San Francisco, coastal place, I had a family, I'm like, I don't really see those places working out, New York City or San Francisco, and I found Austin. Moved here, and for a lot of reasons you mentioned, but a lot's changed in 7 years actually. So I did raise money, a little under $4 million for my first company.
Who'd you raise it from?
Yeah, who did I raise it? Who did I not raise it from? Yeah, I mean, as some of you know, especially if you're a first-time founder, you take money from whoever's willing to give it to you. Because why? Because social proof, right? That number 4 on that list is such a big deal. But I raised an angel round, and then Josh Baer was one of the first investors. He's the reason that I came out here. I did a pitch competition. I started pitch competitions basically all over the country to figure out like, who is this going to resonate with? I'm in Florida, so I did one in Miami, one in Atlanta, and I did one in Austin. And I noticed that the B2B, like folks understood B2B SaaS really well here, like 2012, 2011. So I ended up moving here, and we went super enterprise with the business. So we actually grew the business from like a couple $100 a month contracts, like swipe your credit card and pay, to 6-figure contracts, usually 7-figure in the case of multi-year deals where we were selling to some major CPG companies. So that was my first business. I'd say it was a success. More to be announced on that at some point in the near future, I hope. But I ended up leaving that business, and now I'm starting my second one, which actually is intended to solve some of the problems I ran into with the first one, a lot of which revolve around fundraising, but financial planning for startups is the core idea. And when I say planning, it's like not just budgeting, but forecasting. So how do I forecast my profitability, revenue, expenses, valuation? You know, a lot of the things that go into a fundraising deck is what I'm really focused on building a product for. So founders are my, free and paid customers, and I'm kind of here to give back as much as I can too. So happy to answer questions.
Awesome. Let's dive into it. Yeah.
What was your first business?
So the first business started out as a weather company. I realized at some point in 2004-ish that weather data was like this freely available data set on the internet, and Web 2.0 was becoming a thing, and I was like, what? I was looking for an idea. I was at my first job out of college. I was like, what sucks on the internet right now and has a lot of data? Because I was listening to a lot of stuff from Tim O'Reilly was giving a lot of great talks back then about what Web 3.0 was going to be about, and like data was a thing. And I basically stumbled across the fact that like weather data was freely available, but like nobody at the time was doing a good job of harvesting it all and putting it into some kind of engine and doing something interesting with it. So I spent the next 10 years basically figuring out how do I take weather data and make it more valuable for people. So it was a big data startup before there was such a thing as big data. We were a mashup, then we were big data, then we were AI, but we waited for like the world to name the thing, and then we were like, well, we're that. We're that too. It was a wild ride. So.
Was it B2B or was it B2C?
Yeah, it was B2B. It was always, we had a freemium product, and so we had a lot of just individuals using it, but our bread and butter customer ended up being a Fortune 1000, and in some cases, so Unilever was a customer, Anheuser-Busch was a big customer, and I sold all those deals myself too. So if you want to talk about enterprise sales, I'm more than happy to tell you what I learned on the road selling enterprise contracts.
You got to pitch Obama here, right?
Yeah, and actually the White House was a customer. Thank you.
Right.
Yes, which is
not just the White House, but like a pretty cool part of the White House.
Yeah, the executive office of the president. So I was looking through the user list one. Actually, what really happened was shortest version in the world. My phone rang and I didn't answer it. I didn't know. Went to voicemail. I looked at the Google Translate and was like, garble, situation room, garble. I'm like, yeah, right. So like I play back this message. I thought it was like a joke. It was like, this is the White House Situation Room calling to like sign up for a whatever. Like, what? But it had a phone number attached. So I literally, they like left me their phone number. So I'm like, I call this phone number and it's like, sure enough, it's got like a DC area code. So I call it up and I'm like, like when you're a kid, you're not supposed to call 911 if it's not actually an emergency. So I call the White House and I'm like, what the heck's gonna happen? And I'm like, I'm expecting to say like, thank you for calling 1600 Pennsylvania Avenue. Like, for the gift shop, press 1.
Right.
But like, no, it rings twice and somebody's like, Situation Room, this is Mark. I'm like, like, what do I say? Like, don't send the helicopters in it. And so I was like, you called me returning a message? Like, first of all, it's not an emergency. Second of all, and I forget what her name was, it's like Nancy called and said that she wanted to sign up. Please hold. So I'm like, oh my gosh. So I'm like waiting. He comes back. He's like, yeah, okay. She's out on lunch right now. Can I take a message? And I was like, sure. So come to find out, I had a freemium product, right? So I'm like looking through my free users, and I'm like, what the heck is this? And like, sure enough, there was a something at nsc.eop.gov, which turns out stands for National Security Council, Executive Office of the President.gov. And I was like, missed that one. Yeah, my marketing tool did not flag that as a premium opportunity in my mailing list, so I just treated them like everybody else. So anyway, Obama ended up coming to here, and the weirdest thing was like they were a customer at that point. So I had this really surreal moment where I got to talk to Obama and like show him a picture of the White House using my product, which I scraped off the internet because they did a tour of the situation. Now we're really going off a deep. I'm sorry. This will come back. Fundraising questions.
This is a great picture.
I'll be here for happy hour. But like they, it was really weird actually. This is the Situation Room gave like a video tour for people to like they remodeled it or something, and they want to show how they spent our tax money. So they did a tour of it, and like I'm like wanting to learn more about the situation now that I know they're a customer. And I go on the White House blog, and sure enough, like they do a video tour. I'm like, oh, this is cool. I get it. And like, you know how whenever they do like a Mission Impossible movie, they have to have some cool stuff going on in the background, like flashy things of like we're launching missiles and whatever. Well, like I had a weather app, and it was like this really cool satellite picture was like the interface. So like sure enough, they couldn't show whatever they were really doing when they did this video tour for the general public. So they put up our product on this 40-inch LCD screen.
That's awesome.
And I'm like looking at this video tour, and I'm like, oh my! So I'm like download, like blow it up really big, and like take a screenshot, and then like this was like 3 years before Obama came to town. Like I had this screen capture, and I was like, I don't know what I'll ever do with this. Well, when I suddenly had to do like 3 slides for the president, I'm like, I know what one's gonna be. So I put up a slide of somebody sitting, and it might have been him sitting in a leather chair, looking at our product up on the screen. And when I had like 2 slides to show him, I showed him one of those, and he's like standing this far apart, and he points, he's like, are those my ears? And I'm like, oh my gosh, like, the president just made a joke about him looking at my product in the basement of the White House. And then my career is all downhill from there. So, I mean,
Well, I imagine that story helped in the fundraising trail at some point.
It never hurt. It never hurt. Yeah, having like the White House logo in 2012 on my website was really awesome. So it was a crazy ride. That was all organic. Can't plan that stuff.
Wow.
You know, life is crazy kind of thing. I wish I could say I like sold my way into the White House, but I never did. They just called me, so, which was cool.
That's how you want it to happen.
Yeah, it was inbound.
Right, inbound.
And it was like I got an Amex card number from them. I don't know if it still works. I don't know what the limit is. I imagine it's a lot. And yeah, that's a small part of my story. But the long story is I survived. I raised money and survived, and now I'm here. So.
And you got a cool story.
It was crazy. Yeah. Very, very cool. Very, very wild. So that was the first business, and you know.
Who else has a question?
Yeah, questions.
I've got a lot, so I'll share. Really fast one is on your accelerator slide for Capital Factory, you said 100K of funding. That's not directly true, correct? Like, what did you?
That's not
someone-
true. I'm not sure what slide that was that you saw that.
It's the accelerator slide.
One of the columns had like 100K in funding.
In our accelerator?
I swear I'm not just like picking out typos that you've had today.
Well, we'll worry about that. We'll fix this later. But
I don't know how. 51.
There you go, 51.
So anyway, okay.
oh, okay. Yeah, we'll check that.
First real
later.
question, because
Yeah.
I was pretty sure that one wasn't right. If your early seed round, like first round of funding, for just like a pure software company at the time, so like I'm a tech founder, just me writing some code in my office, right? What's the expectation from investors of what you're going to do with your first amount of money? Like, I'm mostly interested at the moment of getting myself more bootstrapping money, like for me, because I think I have a very viable idea, like that's why I'm doing it. But I'm gonna run out of money, I think, like if I were to guess. And so like I'm not like, oh, I'd like to raise funding because I'm gonna make you $1 billion tomorrow. I'm just like, no, I kind of just want to keep going. I don't know, like what if the investors kind of a little thinking of what I'm gonna do with that first amount of money, especially when I'm like not sure how valuable it is to hire a person number 2.
Yeah. Are you familiar with the like the business model canvas, or like Ashmore has like lean canvas? So it's basically a diagram of like a business from left to right, and on the left it's like resources. This is the business model version. Resources, and then key personnel and activities, and then in the middle it says value proposition.
Okay.
Right? And like I think about the stage you're at, really, like an investor gives you that first check. On the right-hand side, let's go there for a second. It's like customer relationships and go-to-market model and sales, and like at the bottom, it's like what's your unit economics and all this stuff. Like I don't think the first money in is expecting the right-hand side of that equation to be solved. Like for me, that's you're tinkering. So you're solidly on the left, like you have a key resource, which is you, right? And ostensibly, you're sufficient. Like the work you do is sufficient to solve that middle part, which is like the value prop, right? So it's like if you have, like, I don't know how close you are, but like if you have seed money or if you're about to raise seed money, I mean, better if you don't need it at all, right?
Right.
But if you're taking seed money and you haven't solved the middle part, I would think the basic expectation is like figure out like who's buying or who's using it, right? And like how do you know that the engagement's there or the revenue is going to be there? Like it's really the middle part for me. It's like your product solves a problem for people and you could do that over and over again. Like that's the earliest stage I can think of. Like that's one step above like, let me keep tinkering. It's like, yeah, but to what end, right?
Right, and
So,
that's kind of where I'm at. I was like, why would somebody pay me to keep like?
yeah, the to what end is like, to me, solving the middle part, but I don't know.
Okay.
Yeah, I think maybe another way to put it from a more like kind of investor's standpoint is they want you to buy value at a good deal, and they want to build equity value. They're not really looking to fund your cash flow operations to keep you going. That's more traditional finance, like loans and stuff. They want, what are some strategic things you can go accomplish with this money that will create an outsized return on that investment, right? Even just in a small part. So that could be creating a new product feature. It's like, hey, we want to raise $500,000 to roll out this new product feature, which is gonna increase. It's gonna double the amount of money we can charge our customers every year, and it's gonna add this much revenue. So they want you buy outcomes, right? It might be, hey, we need to build out our sales team so that we can build out our sales team for, I don't know, if it's $1 million you raise or $100,000 you raise, we're gonna go do that for $1 million, but then that sales team is gonna go, create a couple $1 million in profits every year and then grow and stuff like that. So that's like another way to look at it. It's like, what are these milestones that you're gonna buy?
Yeah, like if you figure out that middle milestone, as I was saying, like the next milestone is, okay, some amount of revenue, you're gonna figure out your sales, you're not even figuring out your sales model yet part, like you're figuring out the product, which means that you really haven't de-risked anything yet.
Yeah.
Like it's
Totally.
all risk, like
Yep.
pretty much. So you're looking for somebody who's willing to place a bet on you, right? Which is like, that's really hard, right?
Right.
If I was in that position at one point, right? Which is why I did the pitch contest and everything. I was like, nobody knew who I was. I didn't have a product, like in that sense. I mean, it did have a product, but even with that, right? Because nobody knew who I was and it wasn't making much money, like I think that's kind of the hardest round to raise in one sense. I wrote an article actually on Medium called "The New Bootstrappers," which since you mentioned like just kind of more of the I'm doing this for me and kind of tinkering and this is something I'm doing on the side. Like there are alternatives to VC that are sprouting up more and more. Like Indie VC just did their 2020 round applications. I'm trying to say Earnest Capital, Tiny Seed. Like these are bootstrapper friendly financing terms where they're basically accepting the fact up front, like you don't know if you're gonna be a unicorn or not, but so like don't pitch us on that. But there's investment vehicles now that are more friendly for optionality, where it's like maybe you'd be happy making like $1 million a year as a business with like a handful of employees. Like that sounds pretty life changing, right? It's not a unicorn, right? But there is funding for that now. It's just you're not gonna find it in the VC list, right?
Yeah, and you said your article goes over that.
Yeah, I talk about that. I've got a bunch of articles in Medium about that subject area. It's one I'm pretty passionate
Cool.
about.
Thanks.
Yeah,
That is
yeah.
something I've been super interested in because I was like, I don't care to become super rich, so that's cool.
Sure.
I think maybe him and then him.
I had one regarding that,
Yeah.
the bootstrapping funding.
Oh, you have a question? Yeah, go ahead.
Yeah, related to that. So like, if those funds like provide those vehicles, like how do they make money? I think like the VCs, like they always look for the big exit, so they have like this cash flow event. If that's not the goal of the startup, let's say you have like 2 million annual recurring revenue, like how does that work in the relationship when you raise that kind of money?
Yeah, so the basic forms of that is, one is they will take a residual stake in your company just in case you discover something like Atlassian or MailChimp or one of these like slow rocket ships, if you will, where it's like, we are gonna be worth $1 billion one day, who doesn't wanna own 5% of that, right? Like that's not a bad thing, right? But the primary way they make money is revenue-based financing. So they take a percentage of your gross receipts each month after, say, 24 months. So they're doing rev share, basically, up to a certain maximum. And then the other one is profit sharing, like dividends-based profit sharing. So if they own 10% of your company, they'll give you a generous salary cap, right? Where it's like you're only allowed to bring in, say, X amount of dollars for yourself on salary. So the way you're gonna make the rest of your money is profit. So then they're like, we want you to be as profitable as possible, right? Because we want you to pay yourself dividend checks, and and we get a slice of those, right? So it's kind of like, at that point, they own part of a very profitable business that's just kicking out dividends for them on an annual basis. And they, like to your point about LPs, they have to convince their LPs that like that's the way they're all gonna get rich, right? The hardest part that they have is like markups on valuation is the primary way that people report the success of their portfolio to their investors. And suddenly they have this company that's like not trying to raise another big round, like that screws up their report card in a way. It's like, wait, they're not raising another round of funding? No, they're just rolling in money instead. Like, you know, well, are they gonna exit soon? So anyway, that's what they're trying to solve. Like,
What are the check sizes for those funds?
varies from like 50K to $1 million.
Okay.
Yeah, depending on
The other factor in this, when it comes to how big of a company you need to build to satisfy your investors, the fund size.
Yeah.
And so just within the traditional VCs, it's like, you know, the Andreessen Horowitz, they've got a $2 billion fund, right? And they expect, you know, they might get 10 companies that they invest in out of that fund. They expect one or two of those companies to return $6 billion.
Yeah.
And that's their goal. They need to get, and so if you're getting money from Andreessen Horowitz, you need to be a $3 billion company by the end of it.
Yeah.
Or probably like $20 billion company because they're only going to own 20 or 30%. But if it's a $50 million fund,
Yeah.
way different math equation, right? And so the fund size really dictates a lot of the outcome that the calculus that the investors are doing in the back of their head when they're like, okay, can this get me what I need on my fund?
Yeah. Yeah, it's like in the last 7 years, I'd say like 2013, 14, when I was first trying to raise money here in Texas, it was kind of like, these funds are smaller, just objectively smaller, and in some sense it was like, oh, you know, like it was, I would say, more disappointing, right? Now it's almost like, well, wait, if you have a guy yesterday, he has a $20 million fund in San Antonio, and it's like, you take, you know, $500,000 from a $20 million fund, and you sell for $50 million, like they're super happy, right? That's not a problem, in other words. You sell for $50 million, I'm taking money from Andreessen, and it's kind of like, okay, what are you doing next, right? Like,
No, it's more like, don't talk to us.
Yeah, right.
It's not even like,
yeah,
what are you doing next?
like, did we get all of our money back? I don't, yeah, so, but like, that's not a problem these days. Like, I have a formula in my head for the new company I'm starting, which is like, you know, hire less, spend less, raise less, retain more optionality, right? Like, that's a formula that works for Texas really well too, right? Like, hire more, spend more, raise more, that's a challenge, right? Now you're on the treadmill, right? So it's weird, like at some point I feel like it shifted where it's like, cool, you have a $20 million fund, like that might be great for you because now the bar, everybody's gonna still talk about the bar being this high, but like, you know, actually they were out of Rackspace and Bill Babel and like Webmail. Webmail raised like 500K and sold for 50 million. That's awesome, right? And I feel like in some sense, 100 of those is just fine for everybody in Texas.
Right.
So, yeah.
What you just alluded to brings a question to my mind. How do you determine the size of these funds so you know who to approach? Because you could be barking up the wrong tree real easy.
Yeah, I mean, they should tell you. They should tell you, right? That's a fair
How do
question.
you determine, actually get the data?
Yeah, can I go find out someplace?
Crunchbase.
Crunchbase.
Crunchbase.com.
Yeah, Crunchbase is a pretty good place to find that. Some of them will have it on their website, and if not, you know, any associate can will tell you that.
Will tell you?
Transparent. Yeah.
It's
Just
not a
ask.
secret. It's not.
No.
It's usually not, that's not secret.
Not really secret.
So are there quite a few of them in Austin here, or those kind of funds?
Which kind?
The small,
Yeah.
Less than $100 million.
Most VC funds in Austin and Texas are about $100 million, and then there's a smaller class of funds that's like $20 or $30 million.
Yeah.
There's no real funds in the early stage venture market that are bigger than that. There's the largest one that does early stages S3, and I think they're a $400 million fund. I think he had a question. I promised him earlier.
So I got a question. You said something, Nick said something too. I mean, you said that when you began, you looked into what was out there and you saw something that was free, data that was free and that was not being used. And you said that type of VCs in San Francisco, California, different than here. So my question is, what are investors investing here? What are the type of, I don't know, markets that they invest here? I mean, is it like a Match.com or they're gonna do, what are they mostly doing here?
I think what's really special about Austin is it's very diverse, and Austin is a city that can build companies of almost any kind. Our bread and butter, the furthest history in Austin is enterprise software and B2B software, and that's, Austin Ventures, which was the first VC fund, used to be the only VC fund. They did all enterprise software. Vista Equity, big, $16 billion private equity group, all enterprise software. So that's big, but we're very, very diversified now. And most of the funds are very open to really any companies that are highly scalable and capital efficient.
Now, the second question that I have is that I think that the same way that investors do when they are grading you, you also have to be able to grade them, because you don't only want the funds from them, you want somebody that's gonna, hey, you know about this business, you helped other people to be successful, right? So what's the best way to get to know the street cred that investors have?
Talk to their customers. So if you can, you should be able to, with, it's perfectly reasonable to ask to talk to other founders they've invested in if they feel like you're far enough along in the process, right? I mean, hopefully you have that problem of being selective about who you're going to take money from, but if you get that far in the process, ask them to talk to other founders who've taken money from them and do a background check essentially on them is totally fair game.
I would definitely, I would ask to talk to them, but I'd also try to they're gonna send you the ones that like them, right? And so it's also go figure out who are the ones they're not sending you and go track them down and at least get one or two of their feedbacks too. But yeah, I think that's really the main way. Obviously, also the other thing, which is probably goes without saying, success stories, right? And if they're like, hey, this business is a very similar business model, they've funded successful companies before, that's a really good start.
Yeah.
In the back?
Yeah, so I have a couple of questions, but I'll try to compile them into one. So one thing that usually comes up is the word pre-seed versus seed money, right? And I feel like it's kind of a gray area as to where that, for me, I don't really understand what pre-seed versus seed is. And the second part of the question is, as an LLC, do you have to switch over to a C corp if you're gonna go into seed? And I guess I don't know what the other implications of that would be.
Right. I can answer part of that, but short version, no, you don't, strictly speaking. My second company's an LLC for now. I did through Stripe Atlas, which was $500, incorporates your business, gives you a bank account, gives you an operating agreement. It's pretty cool. I can convert it to a C corp later. They've got docs for that as well. Yeah, so for $499 in 72 hours, you can have a C corp or an LLC from Stripe.
Stripe?
And a bank account. Yeah.
That's pretty cool.
Yeah, so legal fees gone. I mean, I think I spent $10,000 doing that the first time 7 years ago. So yes.
Yeah, it's also, I just filed an LLC myself for free. That was
super.
It was one page. I'm like, people pay a lot of money to do
It's
this.
gotten easier, yeah. But the bank account, everything. So anyway, however you do it though, the key thing is just remember, some investors don't want to invest in LLCs. Capital Factory's gotten figured out how to do that now, which is cool. You're selling units, not shares. If you have an LLC, losses and gains are passed through, which can be great, unless you're spending investor money, in which case it doesn't count as a loss for you personally. But if you're putting in your own money, it does. So if you are profitable, just keep in mind your profits when you're converting, right? If you're about to have a profitable year or you're about to have a year of losses, be mindful of that before you convert so that you get the tax benefits.
Yep.
But strictly speaking, no. And then the labeling thing, I mean, I think of it as fundraising has become much more high resolution, to use Paul Graham's term, where it's it's happening more frequently, higher cadence, and the lines are blurring for sure. It's in some sense the names are just invented by entrepreneurs to help draw lines in the sand of pre-seed, pre-seed, seed, C2, C3, C4. And it's at some point it doesn't really matter. It's more of a, what name do you want to give it to tell the best story of the milestones that you're hitting? And use as many of the labels as you can without sounding silly, the other way of thinking of it. So the first money is pre-seed. What he was just on, definitely pre-seed. Seed to me is what an A used to be also. The reason that names are getting invented is that the bar that you have to hit to raise money is getting pushed higher earlier in the process. So what you have to raise a seed round now, if you're talking about like a $2 million seed round, which didn't used to exist, like a $2 million seed round used to be an A. Right? So we had to kind of invent the name pre-seed because it's like, well, what about all the hard work I did before that, right? Well, that was pre-seed now, right? So in some sense, because the bar's gone up for the rounds, we've had to invent names for earlier rounds that are getting created. Because like a $2 million seed, like that was crazy. That was an A
Right.
10 years ago, right?
Follow-up question though. So you said these bars are getting pushed back. Are
They're
VCs setting these bars? Who set these bars? Like what?
Well, the big ecosystem picture would be you have people like the Sovereign Wealth Fund and SoftBank and others with cajillions of dollars who are looking to invest in things that are not correlated with public markets and are better than treasury bills, investing at later stages. And then those guys are like, great, like we now have to compete with these guys. We don't want to do that. So where are we going to invest? Well, we're going to invest earlier, right? And these guys are like, well, now we're getting, so literally every tier of this money supply chain is like, has new competition. And so like the people that were at Series A are now like, well, you know, we used to expect a certain return profile. In order to find that, we have to go earlier, right? And so in some sense, like money entering the ecosystem, money's cheap now, and it's just shoving everything downstream, which is great in one sense. It just means that like, yeah, now your seed is what an A used to be, right? And an A is really hard to raise now compared to what it used to be.
And I think the demand for capital has gone way up, and this used to be a very niche thing, and there was a very small number of businesses that even tried to raise venture capital, and now in the world of Shark Tank and Steve Jobs, like it's like this is like people like the default is go raise money, even though it shouldn't be.
Right.
And like we've got a pretty standard response to the pre-seed seed thing that I'd share. He's totally right. They're all labels. It's a marketing terms. Like it's well, we really think there's like two distinct phases of a company or two stages of a company, and there's the seed phase, and then there's the growth phase. And everything in the seed phase is experimentation, trying to achieve product market fit. And then once you have product market fit with a big enough market, you start a growth phase. And essentially that's like once you have product market fit, that's where today's Series A investors, the investors that will write you a $5 to $10 million check, get interested. Before that, it's this, and it's 10, 15, 20 years ago, there was barely any seed funds, and now there's all these different stages of seed funds, and so you kind of have all of these rounds inside of this phase, and so it's like you got your angel round, you could do in your seed phase, you could do a friends and family round, an angel round, a pre-seed round, a seed 1 round, a seed 2 round, a seed 3 round. Maybe that only equals $3 million, and then you've got product market fit, and then you go, all right, I'm going to go to the Series A investors that are doing big checks, and I'm going to go raise $5-10 million, and that works fine.
Yeah.
So there's a lot more options.
Question that comes to me is, I hear everything you're saying. What are you going to give away in the seed time? I would imagine you've got to give a higher percentage of your company away at the seed round because there's a higher risk, and that once you get to A, that you, as a company, you get more bang for your investment buck because you don't have to give away as much. Is that a reasonable way to consider this?
I actually think no.
Yeah, I don't
you're
think
giving
that's
away. Yeah, you're giving away less because you're raising so much less. Like you might raise 10 times less money in your seed, so you might give up half the dilution. So like what is it? Very rough. Think about like a 10 to 15% seed round, right? A 20 to 25% A round, if you will. And then after that, it's like, well, how are you doing? Right? Like if you can survive, if you have to keep raising money and you
the
can
reason I ask
do
it is like what you just said says keep 35-45% of your company to give away.
You should expect to dilute don't dilute more than 25% between like your seed and your. If you can dilute less than 30 between your seed and your A, like you're doing really well, right? But like diluting 30-35%, and that's not including options pool, right? But the advice I would also give is if you already have a co-founder, this doesn't help, but like your co-founder is the most expensive round you'll ever raise because you start at 50%, right?
We started with 3 equal co-founders.
So you started at 33%, right?
Well, no, we didn't actually.
Okay, maybe you didn't.
We issued the stock, and originally we to the let's keep 25% for investors.
Mhm.
And what I think I'm finding now is, that's delusions of grandeur. We're not each gonna keep 25% of this company. This is gonna be something more like we all might keep 15 to 20% of the company, and the rest of it's gonna be necessary in order to get the company started and grow.
Depends how capital intensive it is, right? Like, Aaron Levy went public with Box and owned 4%. It also depends how much leverage you have in the negotiations. Like, second-time founders often have 3, 4, 5 times more equity when they go public than first-time founders.
Well,
And
we're all
what is
first
that,
time.
right?
We're all first time.
Yeah, no, I mean, we're all first time in a sense, but what I mean is, like, well, why? There's no mathematical reason other than it's the terms you have the privilege of raising on, right?
Well, the capital intensity is a really interesting question because it's capital intensive in the beginning when you don't have any money, but if you can get some revenues, we could certainly grow it with minimal revenues. I don't see needing a seed round or,
Yeah.
once we get seed money, we're going.
I think the big factor,
Yes. Yes, you
the
are.
big factor is every investor is going to have a target ownership percentage.
Yeah, that too.
And that's kind of what I'm asking.
And really it circles around that, and like it's usually a range that's got about 5%, and you're talking to the investor, and if the deal's going to happen, it's going to happen in that range, or it's not going to happen. So
Yeah.
Is there a way to figure that out, that range?
ask them.
Yeah, you can ask.
Oh, they're open about that.
Mhm.
They should be.
You gotta, you always gotta be like cordial, like ask it tactfully, and not like not be like
Negotiations,
aggressive.
They can say anything, like.
Yeah, it's just kind of built the idea. Good. I had one back there.
I've heard both of you make a comment to the effect of not raising money if you don't have to.
Sure.
In different contexts. I guess my biggest question is, if I don't have to, why should I?
You shouldn't.
To resolve the tautology, you shouldn't. But you will come up with reasons maybe why you want to, right? But if you don't, then don't, right? I mean, the only reasons but you'll come up with reasons.
Can I time
right?
box it?
Sure,
So,
yeah.
like early on, I'll say it that way, right? Like, we talked about bootstrapping and other things.
Mhm.
So one argument would be, hold on to as much as you can, don't get investors if you don't have to, continue to report to yourself, right? The other argument would be, put less of your own capital at risk,
Mhm.
right? Which is counter to the idea, if you believe in it, why would you, right?
Sure.
So I'm just trying to look at from the other side, which is, if you don't have to, would you? I mean, in your particular case, you're doing it again.
Yep.
I don't know if you're raising money or not.
Yeah,
I don't know
have.
I don't know if that was a choice or not.
Yeah, it was a conscious choice. I mean, I did it because I do think good money from the right people comes with expertise, connections, accountability,
That's what I'm getting.
right, experience, yada, 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 right? And maybe more money when you need it, right? And other people's money is less risk than your own, but we get in the percentages story as well, right?
So I guess, how much value would you put on these relationships in your experience? I mean, are they invaluable? Do they open doors? Are they connections?
They are, that's a good question. I would think of it like it's a multiplier, and you don't know, it's Wheel of Fortune, right? You're spinning it, and you're like, it might just so happen that investor took money from, ends up knowing the person that you need to hire as your VP of engineering or something. Like, you didn't plan that at all, but like it's a luck surface area thing, as they say, where you're like, yes, that's awesome. Other times, I've taken money from people where it was just money, and that's the most expensive money you'll raise because it doesn't come with anything else. But the worst money you can raise is people who try to get involved and aren't valuable. So we can have a whole separate conversation about that.
Fair enough.
I would try to urge us from being be less binary, and
Yeah.
I don't think it's as much of don't raise money if you can, and raise money. It's I think it's more about alignment, right? And it's like, hey, this is what I want to do with my company. There's this world of investors out there, different types of investors, classes of investors. It's like, or is there a fundraising strategy that I can employ which allows me to hit my goal faster, right? And
Yeah.
I think, it's like, so have you disclosed and announced how much you've raised? Or is
I've only raised $200,000.
Yeah,
so
so just
far.
a small amount
Yeah.
could, help
Yeah.
with that alignment.
Yeah. And I raised it from investors where I knew out of the gate, like, if this turned out to be a business that just made profit, they were okay with that, right? And I talked to them about that up front because I'm like, I don't know if this is gonna be a unicorn yet or not. And frankly, that's a lot of stress. Like, I don't need it to be.
Sure.
You know, do you need it to be? And I will say this, like, I think in a room like this, the vast majority of us, probably statistically speaking, nobody in this room is a unicorn, or is that asset that they're looking for, right? If you know that, and you know the odds of that are super high, like, how do you play the game, right? Don't play the game assuming you are. Like, that's not a good way to start, you know, playing the game, right? Assume that you're not, and give you and your family and your loved ones and whoever you have, yourself, like, the best chance of, like, getting rich without investors, right? Like, that's a good way, you know?
Maybe in the back, let's just spread it out a little bit. And we'll move up here, yeah.
So, on that point, so I just finished putting together a pitch deck after like a year working on a product, and I'm in this like seesaw of, do I over project and make it look like, you know, everybody's gonna be a billionaire in 3 years, or do I really just hunker down and focus on what's realistic and what's not? I have an operations engineering background, so like I put a lot of safety factors into like what I project, but still, I was told one of two things. My buddy who works in New York City for like a private equity firm is like, over project. Somebody here in Austin was like, just keep it real.
That's a great. I mean, that's perfect because I think it depends on who you're talking to. Are you talking to investors in New York? Or are you talking to investors in Austin?
Yeah.
You know, and if you go to, this reminds me. We were doing a panel in San Francisco, and we had a founder, Connor Cunningham, who started Retail Me Not, one of the latest tech VC companies to go public in Austin. And he was getting interviewed by a Silicon Valley VC, and he was talking. He's like, and they're like, "What's hard about raising money in San Francisco as an Austin founder?" He's like, "Well, in Texas, we like to." He's like, "Good old boy, right? Like, talk super slow. Like, in Texas, they like to be honest." And I come out raising money in San Francisco, and we spend $100,000 making these projections, and they're spot on. And I'm gonna hit them, and then they just go divide all my numbers by 2, and then I find out everyone else is pitching them is it's because everyone else and so. But I think here, it's a little more tempered.
Yeah. So quick plug for my new company. It's called Summit. It's financial planning for startups. You don't have to share it with investors, but it basically lets you put in 20 different assumptions and gives you your projections.
Cool.
So sales cycle length, pricing, retention, leads, lead volume, lead growth, all that stuff. Basically automates all the spreadsheet work that nobody really loves to do, and gives you projections. Like, I use those for myself, and I mean, this is a privilege, but like, I don't want to pitch investors that need optics to be a certain way, right? Like, that to me is just recipe for like not exciting updates, like later, where you're thrilled, but they're not so thrilled, and then they're not going to be engaged and blah, blah, blah. So, yeah.
I think we have one right here.
Yeah, I'm working on it's a mobile app, and a lot of my background is like talk show host. I'm working on e-town halls to make it like, our end game would actually be firing the mayor and the city council, and like, they're really our rulers instead of our representatives, but it's like a talk show on YouTube that I do now, and trying to grow this into, a lot of other people really like the idea. It's actually what Ross Perot proposed when he ran for president. So I'm actually looking to kind of form a cooperative around this, and like more of a model, not like a LLC and also crowdfunding. I'm just wondering like some ideas of that, like to connect with that.
My question is like, are you building a platform for people to make the kind of
it
change
would be
you're
like-
talking about, or are you solving the problem?
It would be
for
24/7 where you can see all the issues, you can raise issues, you can find the solutions to things going on locally initially, but it's meant to actually replace the local, state, national, and even international. Like, even the UN can go away. Like, we don't, with all this great technology, we don't need them anymore. So it's
Well, I wouldn't say that to
very
everyone.
ambitious. But it's it's real direct democracy, which we have this, take the Athens, Greece model, and it's like, we have this great technology, let's just do it.
Yeah, I mean, my guess would be that probably is happening some other way, like, it just doesn't have a name yet, et cetera, like whether it's Reddit or Wikipedia or whatever, like we have social forms of commentary and stuff happen, like the Agora is a thing, but if you're gonna package that up, like, that to me sounds like technology, not like, I don't know if I would pitch the solution is we're gonna do this and this, unless the technology has only one application.
Well, on January 16th, I'm going down to the local public broadcasting channel and to start a new network, you know, to be a producer, to create the content. So it's both coming in from the local, you know, you can vote on your phone and you can vote from your app. It'll be an app eventually, and like, you know, so it's all going to be connected. You know, public radio, public broadcasting, and it's actually from onevoicenow.org is like the original person who had the idea.
Yeah, I mean, my thought is just like people, it sounds like a cause and like an awesome thing, and like the investor reaction, the little investor gremlin in my brain says like, how does it make money, and is that really a business? And it obviously has a lot of risk, right? For somebody who's not as, sounds like you know it.
Well, it's just
inside and out.
trying to, you know, all it takes is like some celebrities to get behind this and some other people.
Yeah, yeah.
You know, and it's done.
Sure.
Yeah, I mean, it sounds like maybe a nonprofit thing.
Right.
You know? Or
Yeah,
maybe
yeah.
there's like a nonprofit that runs in tandem that kind of builds this community, raises money, does events and fundraisers, and then maybe buys the technology.
Yeah, like,
or
can you be the technology in some sense? Because
Yeah.
Yeah, I was just wondering if you knew of people who hold your hand through like co-op, collaborative type business models, and also like crowdfunding. You know, any resources in that help you?
I don't personally.
You know, there's a lot of crowdfunding platforms out there. One in Austin is Micro Ventures. So one locally, you could probably get in touch with them. What was the first part of your question?
More like I've already know about SCORE is like a really good one where retired people will come and like help you out.
Right.
You know, think more like that where they kind of,
Yeah, I'm getting like the people that I think would be most interested in what you're doing are like the donor community, right? And so there's some, I don't know if there's like a foundation or a family office or, you know, it's not too much different than the angel community, but it's just, I think, at least what I'm hearing, you're not pitching it in a way that like perks my ears up from this is gonna grow and be a big product. You're pitching it like, hey, this is a big movement, a big cause that like, that you're, you know, you're kind of pitching me like a customer, a user, not an investor.
Yeah, yeah,
And so it's kind of hard to say from a funding standpoint how it would
The
work.
crowd part makes sense in that way of like people believe in this, right? And they're gonna give to it, but they're not investing in it. They're just like, man, I hope you're successful. Here's X dollars, right?
Yeah.
Yeah. So that makes sense.
Which the people in town might make a sense for you. Trust Ventures.
Okay.
I don't know, but they're a VC fund, very kind of tied up in the regulatory political world.
Okay, thanks.
Couple more questions.
Does Capital Factory only focus on tech startups?
We are definitely tech focused. I wouldn't say we only focus on tech startups. It's hard to answer because I think the definition of tech is evolving a little bit. You know, the reasons that venture capitalists invest in technologies isn't because technology is cool. It's because they create highly scalable, capital efficient businesses.
Gotcha.
And with all the technology that we now have in the world, like you can have highly scalable CPG businesses and other types. So that's what we care about is, hey, can this company provide an outsized return? Is it capital efficient? Is it scalable?
Yeah, does Capital Factory have a structured program for entrepreneurs to go through?
Mm-hmm.
How many people go through it a year?
We have a lot of programs. Our core one that I think would stand out would be our accelerator program. And we onboarded, to qualify for that program, you pretty much need all those top 5 items. Product, initial customer traction, team. We onboarded about 120 companies last year into that program.
How many get rejected?
I don't know. I mean, we have about 100 apply every month, so
Okay.
it's a lot. We don't count how many rejected.
Okay.
I don't, at least.
I want to bring it back to fundraising. So we talked about like different sub rounds within seed rounds. So you talked about like a family and friends round and like a angel round. So I don't know if this is the right way to do it or not, but like right now with my friends and family, I'm offering safes. You know, like, hey, give me some money, it's gonna equal money later. But for an angel, I don't know if that's necessarily gonna be the same thing or just as valuable as like a convertible note or some sort of like actual established amount of percentage. So if you guys could, I guess, kind of shed some light on what are some different financial tools or fundraising tools in terms of like interested in versus like, you know, a safe or convertible note? I don't know if I'm clear with that question.
Yeah, I can try that. So I raised money from a lot of angels. I think like convertible notes are very familiar to most people, and you're going to have the least amount of education to do in some sense, other than price round. Price round is like the most simple, but outside of that, obviously there are safes. But safes, it's a YC thing. You probably find a lot of people in Austin who do those, but like angels that are not as sophisticated, like you have to kind of, you are the lead, if you will. If you're herding cats and you're just collecting a small amount of money from a lot of people, like therefore you're picking the terms. And I think the one thing depends if your safe is like pre-money or post-money, and whether or not like you can easily figure out how much they're gonna own with it. Like a post-money safe, you'll actually be able to do the math and say like, you're gonna end up with, you know, almost exactly this amount of money, ownership percentage, right?
Oh, okay.
Yeah, so you can read, like you recommended Y Combinator earlier, we'll go through this, but like I raised on convertible notes, but that was, you know, 5-6 years ago. You know, now safes are a lot more common. With angels, I think it's probably one or the other. Price round with angels is just gonna be really hard because you have to have it, you know, one closed date for a whole bunch of people. It's not fun. I've done that too.
This touches on kind of like who you want as your investor as well. Like I don't know if I'd like, if you want to raise money on a safe and you feel like that's the best option, I think like the best investors, angel investors for you, they'll invest on a safe.
Sure.
Sure.
And they'll, even more so convertible note. But I think if you encounter someone and you're raising, and they're trying to get you to go do one of these other instruments, like that's an immediate red flag. And it's like, no, because that's the person that, like you said, is gonna try to put their hand in the cookie jar after they invest, and always, and you know, isn't, you know.
Yeah.
And so I think that if they try to like, that just means it's not a fit, right? If they're like, hey, I need it to be an equity deal, like I wouldn't change your strategy for any one investor. It's like, this is my strategy, this is what's best for my company. I know like this is attractive to a certain class of investors, whether that's the class that invests in safes and convertible notes, whatever it is.
I would, my like, you'll thank me later advice would be just like complexity is the enemy, right?
Yeah.
So for crying out loud, whatever you do, like don't get cute or creative with your fundraising unless you have to. And like, then it's like, yay, we have this term we can use, but like, otherwise you will hate yourself later because you do not want to have, you know, 4 classes of shares and these guys got this and these guys got like, the more of that you have to deal with, the more expensive later, the more likely you're gonna make a terrible mistake. Like, oh, I forgot that this guy had a 3-month this and no, like, so if you're already using safes, like to some extent I would just say like, what's wrong with just continuing to use the same instrument, right? Like that, just less overhead for everybody, less legal fees.
I don't feel like the instrument is gonna be the reason why a good investor isn't gonna invest.
Right.
If that's the reason, it's probably not an investor you want.
Okay.
Everyone, thank Matt for joining us tonight. Want to just have Jamie in the back raise his hand. Jamie's one of our venture associates. Clap for him too. Yeah, look at him. Killing it in the back row. Jamie's a great person to talk to if you're interested in getting plugged in the Capital Factory. I am going to have to run out of here right after this, but we have a happy hour in the kitchen. Rebecca is in the back. She's our events coordinator here. She puts this all together. She'll lead the group back.
Yes, I will.
Great, we'll have drinks and snacks and hang out. Sweet. Thanks, y'all.
Thank you.
Thank you.
Thanks for having me. Appreciate it.